There was a time in America when owning a home wasn't a fantasy, it was a milestone. You worked. You saved. You bought a place to call your own. It wasn't easy, but it was possible. But today, something has changed. And millions of Americans are starting to realize a hard truth they were never prepared for. Homeownership, the foundation of the so-called American dream, is slipping out of reach for entire generations. Not because people stopped working hard. Not because they stopped trying. But because the math no longer works. Home prices have doubled, in some places, even tripled. Wages? They didn't even come close. And just when people thought they could still catch up, interest rates exploded. The same house that once felt affordable, now costs hundreds of thousands more over the life of a loan. And here's the part that makes it worse. Even people who are ready to buy, can't find homes to buy. Because there simply aren't enough of them. So families are stuck renting. Paying more and more each year, with nothing to show for it. While the gap between those who own and those who will never catch up keeps growing wider. And for young Americans, it's even more brutal. Saving for a down payment today feels like trying to climb a mountain that keeps getting taller every year. So the real question is no longer just why are homes so expensive? It's this. What happens to a country when the next generation can work full-time, do everything right, and still never afford a place to live? Because that answer changes everything. Before you leave this video, I want to say something real. This channel isn't just another page on the internet, it's built for people like you who want the truth behind what's really happening in the world. If you're watching this right now, it means this message reached you for a reason. And I want you to understand something important. I will be uploading more videos on this exact topic, breaking it down in a simple, honest way that you won't easily find anywhere else. So if this content made you think, or opened your eyes even a little, then do me a small favor. Hit that subscribe button. Because when you subscribe, you're not just supporting the channel, you're making sure you don't miss the next video that could explain even more of what's going on. And honestly, I don't want you to feel like you're just watching from the outside. I want you to feel like this space is yours too. So go ahead, subscribe now, and I'll see you in the next upload. There was a time in this country when buying a home felt like something almost anyone could do. You worked hard, you saved up, you found a place you loved, and you signed the papers. Maybe it took a few years. Maybe you had to compromise on the size or the neighborhood. But the path was real, and millions of people walked it. That time is gone for a lot of Americans, and the numbers make it very hard to argue otherwise. Today, the idea of homeownership as a natural part of adult life, as something you could expect if you just did the right things, has slipped out of reach for a huge portion of the population. Not because people stopped working hard. Not because they stopped saving. But because the system that once made homeownership possible has changed in ways that make it nearly impossible for regular people to keep up. Let's talk about what has actually happened, because this is not a simple story. It is not just about home prices going up. It is a combination of forces that hit at the same time, and when you line them all up together, the picture is pretty overwhelming. Start with the price of homes themselves. In the early 2000s, the median home price in the United States was around $170,000. By 2024, that number had climbed past $400,000. In many cities, it is far higher than that. San Francisco, New York, Los Angeles, Seattle, Austin, Denver, these are places where the median home price is not just high, it is so far beyond what a normal salary can support that even people with good jobs are renting apartments well into their 40s and beyond. But here is the thing people miss when they just look at those numbers. It is not just that prices went up. It is that they went up much faster than wages did. When prices rise and wages keep pace, things stay manageable. When prices rise and wages stall, the gap becomes a wall. Over the past 2 decades, home prices in the United States have increased by more than 150% in many markets. Wages, on the other hand, have gone up maybe 30 to 40% over that same period, and that is before you factor in inflation eating into what that money actually buys. So the math is not just difficult. It is working against ordinary people every single year that goes by. Then you add in interest rates, and the situation gets even harder. For a long stretch of time after the 2008 financial crisis, interest rates were kept extremely low. That meant that even as home prices were going up, monthly mortgage payments were somewhat manageable because borrowing money was cheap. A lot of people locked in 30-year mortgages at rates around 3%, and those people are sitting in a comfortable position right now. But starting in 2022, the Federal Reserve began raising interest rates aggressively to fight inflation. And mortgage rates, which had been hovering around 3% for years, shot up past 7% and then even higher. What does that mean in real terms? It means the same house that would have cost you $1,500 a month to finance in 2021 might cost you $2,500 or more to finance today. That is a massive difference. For a family trying to budget, that extra $1,000 a month changes everything. It is the difference between qualifying for a loan and not qualifying. It is the difference between a payment that stretches you a little and one that breaks you. And because existing homeowners who locked in low rates have very little reason to sell and take on a new mortgage at a much higher rate, the supply of homes for sale has dropped. People are staying in their homes longer, which means fewer homes are available, which keeps prices from falling even as rates make those prices harder to afford. It is a trap, and millions of Americans are stuck on the outside of it. The inventory problem is something that does not get talked about enough. For decades, the United States did not build enough housing to keep up with demand. There are many reasons for this. Local zoning laws in most of the country make it very difficult to build dense housing in places where people want to live. Single-family zoning, which restricts large portions of most American cities to only one house per lot, means that the only way to add housing is to build out instead of up. But building out means going farther from jobs and services. And the places close to jobs and services are often locked into zoning that prevents the kind of density that would bring prices down. Add to that the time and cost of getting permits, dealing with local opposition, managing rising construction costs, and the result is that builders have not kept pace with population growth and household formation for a very long time. Some estimates suggest the United States is somewhere between 3 and 5 million homes short of what it needs. When demand is high and supply is low, prices go up. That is just how markets work. And in the housing market, the consequences of that simple equation are being felt most sharply by young people and working families. Speaking of young people, the generational dimension of this crisis is one of the most striking parts of the story. If you look at homeownership rates by age group over time, the contrast is stark. Baby boomers bought homes at high rates when they were in their 20s and 30s. They bought when prices were lower relative to income, when rates were manageable, and when a single income could often support a mortgage. Millennials and Generation Z are trying to buy homes in a completely different environment. Many of them also graduated from college with significant student loan debt, which affects both their ability to save for a down payment and their debt-to-income ratio, which is a key factor in mortgage qualification. The down payment barrier alone is enormous. On a $400,000 home, a traditional 20% down payment is $80,000. For someone making the median American household income of around $75,000 a year, saving $80,000 while also paying rent, groceries, transportation, insurance, and everything else that life costs is not just difficult. It is, for many people, functionally impossible within any reasonable time frame. And lower down payment options exist, but they come with mortgage insurance costs that raise the monthly payment further. There is also the reality that renters are not exactly saving money while they wait. Rents have gone up sharply as well, for the same underlying reasons that home prices have. Not enough housing, too much demand. In many major cities, rents for a basic two-bedroom apartment are well above $2,000 a month. In coastal cities, $3,000 or $4,000 is normal. When you are spending that much on rent, saving for a down payment at any meaningful speed becomes very hard. You are essentially pouring money into a situation that builds no equity for you while simultaneously preventing you from building the savings that would let you get out of it. This is one of the cruelest parts of the current situation. Renting is often described as throwing money away, but for many people it is not a choice they are making freely. It is what they can afford. And while they rent, the gap between where they are and where they need to be to buy a home keeps widening, not narrowing. Corporate and investor ownership of single-family homes has added another layer to this problem. Over the past decade or so, large institutional investors have bought up significant numbers of single-family homes in markets across the country, particularly in the Sun Belt states. Companies have used algorithms to identify undervalued homes, made all-cash offers that regular buyers cannot compete with, and converted those homes into rentals. While the total share of homes owned by large institutional investors is still relatively small as a percentage of the overall market, in certain neighborhoods and certain price ranges, their impact on available inventory and competition has been real and measurable. When you are a first-time buyer trying to compete with a cash offer from a corporation that has billions in assets, you are not playing on a level field. The geography of the housing crisis matters too. Not every part of the country is equally affected. There are still places where homes are relatively affordable, smaller cities and towns in the Midwest and South, rural areas, places without the same job density as the major metros. But here is the problem. The places with the most affordable housing are often the places with fewer job opportunities, less access to good healthcare, lower quality schools, and weaker infrastructure. Affordability in these places can reflect the lower value that the market places on living there, not just lower prices in a vacuum. People do not always have the freedom to simply move to where housing is cheaper, especially if their job, their family, or their community is rooted somewhere else. And even in markets that were once considered affordable, prices have risen dramatically. Cities like Nashville, Phoenix, Tampa, and Raleigh that were affordable just 10 years ago have seen prices surge as people and businesses moved there during the pandemic, often bringing money from more expensive coastal cities and inflating local markets in the process. The affordable places are becoming less affordable, and the expensive places are becoming nearly impossible. The psychological toll of all this is something worth acknowledging. For generations, owning a home was tied deeply to the idea of stability, of having made it, of building something that was yours. When that goal becomes unachievable, it does not just affect bank accounts. It affects how people feel about their futures, their place in society, their sense that hard work actually leads somewhere. Survey after survey shows that younger Americans still want to own homes. The desire has not gone away. But the belief that it is actually possible has been shaken. And there is a difference between a dream deferred and a dream denied. Policy responses to the housing crisis have been debated extensively, and there is genuine disagreement about what would actually help. Some argue for zoning reform, making it legal to build more types of housing in more places, as the most fundamental fix. If you allow more homes to be built where people want to live, supply goes up and over time pressure on prices eases. Some cities and states have started moving in this direction, but the changes are slow and face real opposition from existing homeowners who have an interest in keeping property values high. Others point to the need for more government-backed affordable housing programs, expanded first-time buyer assistance, and limits on investor ownership of residential properties. Some advocate for rent control as a way to give renters more stability while longer-term solutions are developed. Each of these approaches has supporters and critics, and the honest answer is that no single policy will fix something this complex. The problem built up over decades, and it is not going to be solved quickly. What is clear is that doing nothing has costs too. A country where large numbers of people cannot afford stable housing is a country dealing with downstream consequences. Reduced economic mobility, harder family formation, geographic concentration of wealth, and growing resentment between those who got in before prices exploded and those who were locked out. These are not abstract problems. They shape communities, elections, and the social contract that holds things together. The American dream has always been something of a moving target. Every generation has faced its own version of the challenge of building a life. But the specific version of that dream that included homeownership as something most working people could reasonably expect to achieve is genuinely under threat right now in a way that is hard to spin or minimize. People are not failing to buy homes because they are lazy or irresponsible or not trying hard enough. They are being priced out by a convergence of forces that no individual decision can fully overcome. Higher prices, higher rates, insufficient supply, wage stagnation, rising rents, student debt, and competition from investors have all come together at the same time. And until the systems that created these conditions begin to change, the gap between the promise and the reality of homeownership is going to keep getting harder to bridge. That is the honest truth of where things stand. And as uncomfortable as it is to say out loud, naming it clearly is the first step toward actually thinking about what comes next.